even let's say about 6% of GDP for next year, the pressure on borrowings will be quite significant, right? I think the math would probably take net borrowings close to 9.5, more than 12 in gross borrowings, because there is a fair amount of redemption pressure in the next couple of years as well. This year, we managed to push that through. There wasn't considerable credit demand. Do you think next year, and the fact that this will continue for a couple of years, gross borrowings of close to about 12 lakh crore, do you think there's going to be trouble in terms of absorbing that?
It's a great question, Neera. And yes, there will be issues, I think. The overall borrowing, and remember, the states also have to borrow, and states also have redemption of about 2.4 lakh crores. I think the center has about 3.8 lakh. 3.8 lakh crore redemption. So all put together, your net borrowing could be very similar to this year's, about 16 lakh crores, and your gross borrowing could be something like 22 lakh crores. Net borrowing of 16 lakh crores is a problem. Generally, the banking system, insurance companies, pension funds, the normal ecosystem can manage about 10 to 12 lakh crores on an overall center plus state basis. So that will leave you a bit of a hole of about 4 lakh crores, 4 to 5 lakh crores, depending. Of course, RBI has stepped in the last couple of years with its own GSAP and its OMO purchases. It probably will not do that going forward. I think the couple of jokers in the pack, one is, does debt inclusion happen into the global indices? If that happens, you could see potentially 1 to 2 lakh crores, again, depending on whose estimates you go by, of additional demand coming through. Even then, you would probably need some kind of support from the RBI, either through OMOs or through nudging of banks by giving them HTM dispensation and so on and so forth, to try and nudge that gap. So yes, the pressure on borrowings will likely remain, to answer your question.
Is that already reflecting in the 250 basis point plus spread between repo and 10-year?
And remember, Ira, this 250 basis point spread is after a fair amount of financial repression by the RBI.
Absolutely. I mean, SLR holdings of banks, I think 10 percentage points or something like that ahead of what they should be.
Absolutely. So I think if you look at the money supply equation for India, about 11 lakh crores of M3 over the last 2 years has come about because of bank funding of government fiscal deficits, both RBI and commercial banks put together. So clearly that, and by the way, last year, if you recollect, I think about 7 lakh crores is what the Indian banking system bought of government securities. This year's been less, but it still bought a substantial number. That's clearly been pushed by RBI regulations. When you give HTM, dispensations, when you ask the market to behave, and talk about 6% being market, what do they call it, market good or something,
public good.
Public good, yeah. So when you kind of give those kind of nudges, plus you're doing your own OMOs and GSAPs, etc., there is a fair amount of repression which has happened. Look, the point is there's been substantial borrowing by the government, both central and state, and by sovereign-owned enterprises. So while we talk about credit offtake having dropped quite a bit, that's been more than made up by the huge amount of borrowing being done. 21 lakh crores this year is the gross borrowing for center and states put together. It's not a small number. It's over 20% or 20% of your overall credit book, right? It's a substantial number. So if it had not been for RBI repression, frankly, this 6.5% would have been 7.5%, or I don't know where, it would have been even much, much higher. So yes, you're absolutely right. This 2.5% spread that you see between overnight and 10-year bond yields reflects this demand-supply mismatch. There's no magic to this. The fact is the longer end is seeing relentless borrowing by the government to fund its fiscal deficit for the right reasons. And therefore, the curve has to be steep. There is no magic to this.
There used to be sort of the conventional wisdom of crowding out as well. Till now, that was not a concern. If the economy picks up, is that something to worry about? Although I know that many people have sort of rethought the thinking on that, on whether it does crowd out or does not, whether it means higher rates. And even if it does, perhaps historically speaking, those rates are not high enough to impede any sort of investment demand, so to speak.
Again, a great question, and you're right. For if you ask 3 economists, you'll get 3 different views on this, and all 3 will probably be wrong. But here is my 2-bit take. I'm not a trained economist, but here's my 2-bit take on this. The crowding out issue or this demand issue. Look, the government is borrowing in the longer end of the curve, right? Predominantly, of course, it's also doing a lot of T-bill issuances and all that, but predominantly the borrowing is in the 7, 10, 15, 20, 30-year kind of buckets, right? We aren't really seeing demand as yet from the commercial sector. It's still very muted. It's still 7% credit growth, but we're really not seeing long-term growth. Now, where you see long tenor demand, let's say in mortgages, actually is floating rate loans. These are all 1 year floating rate loans, which are linked to your 1 year repo rate or your overnight repo rate of 4%. So the demand you're seeing from the commercial side is in the short end of the curve, where there is substantial liquidity and there's substantial support available. So the way I see it is the government is borrowing from the banking system, spending a ton of money through fiscal deficits for the right reasons, creating this pool of money and liquidity, alongside, of course, FX inflows, but predominantly it's come from government spending. And that liquidity is available for commercial borrowing to support commercial borrowing. All this liquidity that you're seeing in the banking system is there. I mean, there's no crowding out as such in that conventional sense. There's no funding crowding out. Interest rates, can they be a problem? They can be a problem. If you do see, and we're all hoping for the investment cycle to be revived, if you do see private capex come back, and therefore people looking to borrow 10-year, 15-year money, then you could absolutely see a crowding out effect because interest rates would, compete with each other. I suspect that would be a good problem to have. The government can probably relax its, government borrowing program and allow the private sector to take over. Long story short, look, yes, conventional monetary policy is going to be very, very queasy going forward. You're playing with lots of variables, not just in India, globally as well. Look at the amount of money we're playing with. But India's solution really is we need the growth impulse to come back. That's an obvious answer. Everybody knows that. But what that means is the thrust that the government has put through, whether it's national infrastructure plan, 111 lakh crores of investments going into infrastructure, which hopefully then kindles private investments, brings in your Atmanirbhar Bharat and your production-linked incentives work out, and manufacturing comes in, and we all start creating jobs and output. If that happens, if that virtuous cycle was to happen, we would solve for everything else. That is the bottom line. It's the real economy which has to now kick in, deliver output and jobs. If that happens, all the sins we've created over the last 3-4 years, frankly, will get washed out.